Blues, let's be careful out there. Every time the guy had a meeting, the guy was either the sergeant or the captain. Let's be careful out there. I think that's what you're saying, because the one thing that's going up that you're seeing, volatility and correlation, which gives a lot of people nowhere to hide. It's time to be careful.
That's right. That was slightly before my time, Joe. But really right now, what I think people need to think about is that the only way out is through, and we have to just let this play out. After a day of indiscriminate selling like we saw on Friday, we may see another one today. We may see it a couple times this week. It doesn't benefit any investor to sell post those days, because usually, and we know this historically, some of the best days in the market tend to happen within 30 days of the worst. So this is not a time to run for the hills, but it is a time to reevaluate what you're buying.
Okay,
you can think about traditional.
Sorry, you can finish that thought, but I was just going to add, you also talked macro, not a lot to be. What's your most positive macro fact or factor? Is there one? It just seems all negative.
Well, when we talk about macro, I think generally what people are looking at is, do we have a recession on the horizon? And a lot of the signals right now, people continue to talk about the economy being strong. A lot of those signals are still showing strength. So think about the labor market, obviously super, super tight. We're not going to go into a recession with this tight of a labor market. We've got PMIs that are still expanding. We have leading economic indicators that are still growing. We have a consumer that's still spending, and consumer sentiment actually bumped up last month. So there's still a lot of signals of strength in the economy, which means even if there is a recession at some point in 2023, you have time. It doesn't benefit anybody to get out of the market between now and whenever that time may be.
Okay. The first thing that you go into, Liz, is that the 75 basis point hike, the talk of it is front and center, even though you don't expect that to actually ever. Do you ever expect a 75 basis point hike this cycle?
Well, never say never. I don't expect it in May or June. But What I was saying in my notes is that the market expects it, and that's really what matters right now, because that's the hand in front of our face. So the market is afraid that we're going to get this big hike. We're going to get even more hawkish behavior than we thought before, and it's going to look like the Fed is admitting that they were way behind the curve. I don't think we're going to get 75. I think we get 50 in May. Maybe we get another 50 in June. And I think some of these indicators about inflation being at its peak will start to confirm that it was, in fact, at its peak. And that'll give the Fed a little bit more flexibility to step back from that heavy hammer and reevaluate the situation.
So if you had cash, you'd buy, though. You'd buy very specific things, defensive positions, which include, you want to go over the staples, dividends, healthcare, low-volume ETFs, unconventional big tech, discount retail. You would even buy treasuries?
Well, so I broke those up into two buckets, and it's low volatility ETFs. Some of the defensives are pretty expensive here, but if you're scared and you think that we're going to continue to have volatility, which I do think we're going to continue to have volatility through the spring and summer, then make sure that you have some of those traditional defensives in the portfolio. Some of the unconventional defensive postures right now would be things like big tech. It would be things like treasuries. People have been so bearish on treasuries for such a long time. Treasuries have sold off more than the stock market already this year. I think they're pretty attractive. And if you want to be consistent with the thought process, if you think the Fed gets to back off of their stance at some point later in the year, you probably see a rally in treasuries. So you want to have that in the portfolio. And then think about some of the longer term themes that are dislocated here on a valuation level. Things like cloud software, things like biotech, where you have growth opportunity going forward. Even small cap value stocks, you can get into those today at a really cheap discount and look out 2 to 3 years, and you probably have some good opportunity.